Hello and welcome. My name is Grant Collins. I'm an independent economist for AIM Research. And in today's weekly review, we're going to talk a little bit about the inflation data that came out, a couple of the surveys that were released, the Senior Loan Officer Opinion Survey, as well as the Philadelphia Professional Forecaster Survey that comes out once a quarter. We're going to talk a little bit, particularly with the debt ceiling conversation, what we should be looking at around there and making some assumptions about, how the government's going to be spending money for the rest of the year and whether or not they're going to raise the debt ceiling or not. So I hope today's video is helpful. There's a lot going on. It was a pretty light data week, but next week you're going to see quite a bit of information. So let me just jump in here and get started on a couple things here. Let me share my screen. Let's start sharing here. Okay, we should be good. Now, let me just give you a broad overview of the data that came out this week. So you had initial jobless claims, you had the CPI, both headline and core, you had the PPI, so the Producer's Price Index. I'm not going to review the Producer's Price Index because I think the CPI is going to paint a very similar picture, but the PPI did drop from 2.7% year over year last month down to 2.3% year over year this month. You also got things like the Consumer Confidence Report. It's a preliminary number from the University of Michigan, but we saw that also decline from 63.5 down to 57.7. And they cited a couple things in there. They cited debt ceiling concerns. They cited still inflationary pressure concerns. One thing that you'll notice in that report is that their inflation expectations number is still relatively high. And then finally, just their general view of the economy going forward from here, they're struggling with that as well. So, when you combine a couple of those together with some of these survey data that come from the Federal Reserve, it kind of paints a picture of a pretty gloomy story. One that I want to hit on first is the survey of professional forecasters coming from the Fed. A couple things I want to highlight here. Just what they believe is going to be the trend rate of growth going forward from here. So you can definitely see a decline in Q2, Q3, and Q4 GDP, potentially a recession maybe in Q3 or Q4. There was an elevated risk of recession there. Here's the 2023 number, 1.3%. That is below year over year trend rate of about 1.8%. So that's important for you to think about because Jerome Powell has been mentioning that over and over again, that he needs below trend economic growth so that way they can bring supply chains back into balance and they can bring balance back to the labor market as well. So that's one big thing I wanted to point out. Another one is the unemployment rate. So I'm going to hop back and forth on you here. We did see initial jobless claims accelerate. Let me just grab my highlighter here real quickly. We saw initial jobless claims jump up to 264,000. Remember, for almost a month and a half, we had claims hovering around 240,000. So to get this elevation or this jump higher and to see this little spike here is maybe troublesome. We've been talking about the labor market losing momentum for some time now, even though there was a big jobs added in the last employment report. When you looked at it from a cycle perspective and not necessarily from a level perspective, you saw this cooling that's happening in the labor market, and there's not as much hiring going on as there was prior. Not recessionary yet. I think you have to look back. So like if we were to just look at some of the recessionary periods like here and here and here, and look, if we just kind of run a line here, I do think you probably need to be above 300,000. You may need to creep into the 350,000 range plus before you need to be concerned about a recession, at least showing up in the initial claims. It's a big reason why the Sham rule down here is still posting a big zero. Remember, this is looking at the U6 unemployment rate today versus 12 months ago. And if there's a significant rise, then that is an indication of a recession. There is a significant rise, but apparently not to trigger this recessionary signal. This again is also, it's going to tell you are in a recession. It's not going to lead or tell us that a recession is coming. So this is like a nowcast. and not necessarily a report that's going to give us some forward-looking information here. You also saw continuing claims jump up as well to 1.81 million here. Again, that's important when looking at this survey because they're seeing unemployment rising to about 4% by the end of the year. There were some significant estimates on the higher side as well that get you closer to the 5. Remember, this is just the mean of the forecast, or just the average of all of the forecasters combined, and I believe there were about 38 of them. Look at the unemployment rate going over the next 4 or 5 years here, 4.3, 4.4, 4.3. So basically you're getting right back to that natural rate of unemployment, which is currently setting at about 4.34 if you're looking from the Congressional Budget Office. Couple more things I want to note here is interest rates. I want to note the 3-month and the 10-year, and I want to note inflation expectations before I look at the inflation data that came out this week. Look at the 3-month and the 10-year. The forecasters predict that the 3-month is just basically going to hold at 5% for 2024. That's an important note comparing it to the market. The market already has them cutting interest rates, which I think is important to contextualize and think about here, because I believe the forecasters kind of believe the Fed, that the Fed is not going to cut rates, that they're going to hold rates right where they are. Now, contrast that with the 10-year Treasury bond holding at 3.5%. This is also very interesting as well, that you're not going to see a big spike here. Now, why do they not see a big spike? Well, look at their inflation expectations. By the end of the year, they're thinking inflation is going to be at 3%. Look at just the CPI and the core CPI. So if both of those numbers are going to be around 3, and we look at the CPI number that came out just recently at 4.9, they're still seeing some more deceleration. And so that's probably why they don't see a big sharp rise in the 10-year. They think that inflation was truly transitory. Transitory may have been a little bit longer than people were expecting, but at least that's what the forecasters are saying here from the Philadelphia Fed survey here. Let's dig into some of this inflation data because I do think it was really important. A lot of the contributing factor for inflation from this report was no shock to you or to I, but it was the shelter component. It's still the service side of the economy that's generating most of the inflation. Like, let's go all the way down here to the bottom, and I'll show you that here. Here's those services versus goods. So goods inflation, whether it's durables or non-durables, looks to be getting under control really quickly. In fact, durable goods, so think those things that you don't replace but every maybe 3 or 5 years. So your washing machine, your floor, furniture, things like that. That's actually showing some deflation, as it's a negative 0.17% year over year. Where the non-durable goods, that 3.18% is coming down pretty quickly. But look at the service side of the economy sticking at 6.8%. Now, remember, what makes up services? Well, it's shelter, it's healthcare, right? And I think you're going to see it show up in the shelter in just a second here. So 6.8% on the services. It does look like it's topping a little bit here and trying to come down. Let's look at like the other components, the food, the shelter, and the energy. Food at 7.64, so that's coming down as well. Energy at 5.93, that's been coming down off of the almost 20% acceleration year over year. Here's that shelter component, 8.1%, and you can definitely see, like I said, let me grab a highlighter here. You can definitely see that it's still moving somewhat higher here. So I'm looking at this and seeing that shelter continues to be the problem, as it's the main driver of services here. In fact, if you were to take shelter out, the core headline number, the headline CPI number would be at 3.4%. Much more manageable. It gives clearer evidence that, hey, maybe they can stop raising interest rates here. It could also mean, that's why they're kind of pausing further increases in the 3-month and not really moving higher or moving lower on the 10-year. So to me, this is kind of the story here, that shelter still seems to be the problem. I've mentioned this in some of my daily notes, but if you look at alternative measures of shelter, because remember, shelter, a lot of this is owner's equivalent rent. So if you actually look at like the Zillow estimate of rent, that's been coming down for some time now. The other thing that you can be thinking about is home prices in general, whether it's the Case-Shiller 20 City Composite Index, that's been coming down for some time. So if home prices are coming down, if the Zillow rent estimate's coming down, I would imagine that we're going to start to see shelter start to weaken here a little bit, and it's not going to be the primary driver of inflation going forward from here. Last thing that I'm going to hit on the inflation side here is the CPI, taking out the food and energy component. That drops to 5.5% compared to the prior month at 5.6%. So that does look a little sticky here, right? And so I think that's something everybody was thinking about in their mind here, is that, oh no, if inflation's going to be sticky, that means the Fed's going to keep raising interest rates. And I don't think that's the case. And it doesn't seem to be the case showing up in the forecasters' expectations either. It looks like the case is that they're just going to hold in a restrictive status for some time now. And I think that's kind of my base case. It's important that they remove cuts off the table and that they just leave rates restrictive to continue to put downward pressure on inflation, because it's clear the momentum on the downside is there, whether you're looking at other components. And you just have this one shelter service component that's remaining just somewhat sticky and somewhat resilient there. Again, it's a big reason why this survey of consumer sentiment is so negative here. It's not just the economic outlook that they're concerned about. It's just what you're seeing in this picture. It's the debt ceiling. So you can see, let me pull up this chart here so you can see it a little bit better. You can see that the Consumer Expectation Index in August of 2011, there was a sharp drawdown in expectations in 2011 during the debt ceiling. And here we are again having a very similar drawdown in expectations of economic activity in this debt ceiling crisis. So I wanted to spend some time today to maybe unpack the government a little bit. This is just simplistic at nature. So this does not give you any forward forecast. It doesn't tell you, hey, the Treasury is going to run out at X date. I just want you to understand what data is going to be important to look at for this debt ceiling conversation, and at the same time understand what the government is spending money on relative to what they're bringing in tax receipts. So let's take a look. The total picture here is federal spending versus the receipts. So if you look at the expenditures by the government, you're looking at roughly $6.4 trillion as of the last prior quarter. And the total receipts are roughly right at about $5 trillion. So these alligator jaws that you're seeing here are widening as the government is spending more than what they're bringing in tax revenue. It's important to see this number because that's about $1.4 trillion that they're going to have to try to make up at some point in time. Now, let's break this down from a yearly number into more like a monthly number. And so here you can see the monthly federal outlays versus the monthly federal receipts. You can see receipts at roughly $638 billion compared to the outlays at $462 billion. It's important to see these two numbers because one, month over month, we can determine whether they're going to run a surplus or a deficit. It just so happened in the month of April, they ran a surplus here of $176 billion. That helps because if you run a surplus, then that goes back into the Treasury General account. So the TGA is setting at about 184 billion. Again, that surplus was about 176 billion. So you can definitely see that when you run a large deficit, that there's some financing that has to be done, and that's why the TGA jumps up. And then as they spend that, of course, and use that funding, the TGA comes right back down. But I wanted to at least show you a little bit about the monthly outlays and what they're actually spending money on, because I think that's really important for you to understand. So that way, when they start talking about, where are they going to cut this funding from, then you can start to understand really what's most impactful. So there's several entitlement programs on here. There's the Social Security, there's the Medicaid, there's the Medicare, there's the TANF, or the Temporary Assistance for Needy Families, and then there's the unemployment insurance. The TANF, I believe, is going to be going away really quickly because this is where the stimulus money came from, right? So you can see the big spike here. You can see the big spike, here, here, and here, right? From where they gave out those stimulus checks to families. However, Social Security is probably the largest one here. Remember, these are yearly numbers. Social Security is right about $1.3 trillion of total expenditures. Medicaid is coming down here in black, and that may be roughly about 800 billion. Medicare is about roughly 900 billion. I'm paraphrasing some of these numbers just to contextualize what the spending is, not necessarily the total amount. And then you've got the unemployment insurance, which is actually really low here at less than $100 billion. And it's because we don't have a lot of active filers right now. Again, as we get more filers, you're going to see this number start to balloon a little bit. But I would expect this temporary assistance for needy families to start to go away as it's been coming down over some time. So I expect that to continue to come down. Truly, when you combine just these entitlement spendings or these social benefits, so to speak, you're looking at just a touch over $3 trillion a year in these buckets. It's important to know that number because let's say you break it down by the month, you may be looking somewhere between $250 billion all the way up to $300 billion. And when the TGA is at such a low level, and you see that the expenditures far outweigh the receipts, even though we ran a surplus in this last month, we don't run surpluses month over month. And so with the TGA at such a low level and at the spending of just entitlements at such a high level, this is where Janet Yellen has her concerns. Now, remember, these are not just the only expenditures. Let's look at a couple more. Let's look at defense, national defense spending, and let's look at interest payments. Again, yearly numbers here, but interest payments have ballooned as the interest rates have risen. So you're now looking at almost $1 trillion in interest payments per year. And you also still have another $1 trillion of defense spending as well. And especially if we continue to fund the wartime efforts in Ukraine and if tensions with China heat up, you imagine that defense spending is going to continue to take a bid. And so this again paints a picture of, look, the TGA is at a very low balance relative to the expenditures that we bring in and the tax receipts that we receive to offset those. If we naturally run deficits because the tax receipts aren't high enough, one can only assume that the TGA is going to drop down at some point as well. Now, what does that mean? Like, what can the Treasury do then at that point? Well, they can do extraordinary measures, or they can start to look at what we call means of financing. Well, means of financing are limited as well, right? So one of them is just a reduction of cash, and that reduction of cash is the reduction of the Treasury general account. So if they run a deficit, they have to reduce the TGA by a certain amount so that way they can fund that deficit. Just so happens they ran a surplus in April, so they put $139 billion back into the TGA account. Now, they also have the ability to borrow from the public, but again, that's gone because you're up against the debt ceiling, right? So you're sitting at $31.4 trillion of total debt. Said another way, that's 120 billion. I'm sorry, it's 120% of GDP. So borrowing is on hold until they raise that debt ceiling. So it's a good thing, again, we ran a surplus here. There is this other means of financing, and this is where I think it gets a little, can I say the word shady? I don't mean to say shady. It's just the nature of the business. They do short-term financing from the Fed. It's very short-term in nature because we do have such a volatile receipt and outlays month over month. When the Treasury runs a large surplus, they throw that back to the Fed so that way they can pay off some of these temporary short-term funding measures that they may have to do. But it is another means of financing. Now, outside of these three areas, you do have the emergency where maybe they are going to prioritize payments. That's one thing that Janet Yellen talked about. She's also talked about looking at the G fund and some of the government retirement plans and stopping the reinvestment of interest so that way they can maybe drop down on their interest payments a little bit here. So they are looking at multiple different measures to try to keep the Treasury funded for as long as they can until the government comes to some conclusion. But again, you're kind of running out of options here with the TGA at such a low balance currently right now today. Now, the last thing that I think I wanted to point out on the debt, because again, I do think it's a reflection of how consumers are feeling. They don't like to know that the government is quote unquote fiscally irresponsible or, out of money, so to speak. Is down here looking at just who owns the debt, because I think this is very critical as far as how far the government can continue to kick this can on the debt ceiling. The fact that most of this $31 trillion is held by the public is comforting. Comforting because the US American people are the primary holders of the debt. And because of that, as long as there's some nationalism, as long as Americans still believe that it's the best place in the world to not only live, but to operate your business and also to invest your capital in, the government does have the ability to continue to run these large deficits and to continue to run this high debt level as long as the public demand is still there. They have started to lose some foreigner demand. You can see that here in red, that foreigner demand has declined after the 2021 run-up here. But foreigners still buy a lot. Roughly about $7 trillion of the debt is owned and held by foreigners. And then, of course, you have the Fed that holds a big portion of the government debt as well. Again, nowhere near the public. The public owns the large majority of this. But you will probably lose some foreigners if there's not some capability or some plan or resolution to close this gap. I'm gonna draw a circle around this, because this is your gap here. The fact that you're spending 6.4 trillion but only bringing in 5 trillion. Again, this is simplistic in nature. I'm not giving you any forward guidance here. This is just the problem at hand. If it were me, if I'm looking at this broadly and try to opine on what the government should be thinking about, there's really only three paths here, right? You either have to cut spending in some form or fashion, which it seems like both sides are coming to some agreements. They both want to cut spending, but they want to cut them in different places, which is where the disagreement's coming from. The other side of this is you need to raise taxes, right? And that's the unpopular side, right? Raising taxes just doesn't get you reelected. It also makes the people feel less and less confident, because now more and more of their money is going to the government, which hasn't proved to be sufficient in spending that money wisely. And then the third way that I would point out is still possible, and I hate how people don't think about this, but you can get productivity picking up, and you can get a wave of productivity that starts to create more economic growth. That greater economic growth will bring greater tax receipts down the road. Those taxes can start to pay off some of the expenditures. But you need to have more than just one here. You need to have a combination of one of those three, either raising taxes, cutting expenditures, and having some wave of technological growth or productivity growth, so that way the economy keeps growing and tax receipts keep growing, right? That's something that I don't think is being addressed in this debt ceiling conversation. Everybody's kind of focusing on the immediate two things, which is raise taxes on the uber wealthy, so to speak. It seems like is the Biden administration's proposal. And then also on the other end is both of them want to cut spending. They just want to do it in different places there. I got a little long-winded here today, but I hope this helps contextualize the debt ceiling problem, right? It's a big reason why that Michigan Consumer Sentiment Report came out so negative. It's a big reason why I think people are getting a little bit worried as we get closer and closer to that June end date. And I hope this makes you see the fact that, look, the TGA is just too low right now with the volatility of the monthly receipts versus outlays. And remember, we just looked at April. You might get a bump here in May from tax because tax day was the 18th of April. But after that, receipts should be dwindling until you get back into the back half of the year, where you have business typically come in closer to the fall type of the end of the year here. So, I'm showing you that primarily to, again, give you an outlay or an overview of just how volatile the deficit actually is month to month, and why that low TGA account is giving Janet Yellen some concern and giving the American people some concern. So outside of hitting on the inflation rate, outside of hitting on the initial claims that jumped, and looking at the professional forecaster survey, there was another survey that came out. This survey was the Senior Loan Officers Opinion Survey. I don't have the data pulled up here, mostly because I don't think you need me to bore you with some of the details that I believe you already know. Newsflash, they're tightening lending standards. Doesn't matter what the loan is, whether it's a C&I loan to businesses, whether it's a residential real estate loan, whether it's a home equity line, whether it's an auto loan. They're really tightening lending standards across the board. So they're not discriminating at all. And that also continues to match what we're seeing in the deposit data. So deposits were down roughly $13 billion here in this last weekly release. I'm sorry. So this deposit data continuing decline here is another reason why they continue to tighten lending standards. What's interesting, though, is this deposit decline was less in the small banks and more in the large banks. So let me come down here and show you again. Here's the small bank deposits. I'm going to zoom in a little bit. I think I've mentioned this several times. I need to actually shrink this chart so you can see the moves a little bit better. But there was actually just a decline of 0.3. I believe it's in billions. I believe it's in billions of dollars. But minus 0.3 was the deposit decline for small banks, where the large banks was really the biggest decline here at minus 13 billion. So, in looking at that, that I think continues to reflect that loan officer surveys pessimism. It reflects the pessimism of consumers. If they can't get a loan from the bank, then there's a lot of activities or projects that they're not going to be able to do. There's a lot of activities and projects that corporations aren't going to be able to do. And so, this week was primarily filled with a lot of negative information. The core CPI report was a little sticky. The professional forecasters kind of highlighting a slowing of the economy going through the rest of this year and a rising of unemployment. And then also the fact that initial claims ticked up to 264, everybody again getting concerned there. So if you're a market participant, I believe that this week goes to the bears from a data perspective. I still think it's an economy on balance that's growing below trend. I still think it's an economy that is going to have trouble avoiding a recession because you do have a potential shock that could come along the way. Again, I've mentioned this in some of my daily reports. When you have the economy growing below trend, it's vulnerable to those shocks. The shocks that I'm personally looking at are these bank failures, the debt ceiling and the government funding. You also have Russia and Ukraine tensions heating up, and then you have China-US tensions heating up. These are the four areas that I think that you could potentially get a shock from. And you can look at some of credit spreads as an indication of how that risk is building and how it may be manifesting. We've seen the triple B spreads, and we've seen the high yield option adjusted spreads accelerated a little bit over the last week. We've seen the 3-month minus the 1-month spread expanding as well, as the 1 month is close to 5.5%, where again the 3-month is maybe setting around 5% a year. So these things that I'm looking at definitely paint a picture of potentially crunchy activity, a credit crunch type environment, because we wouldn't see the tightening of lending standards, we wouldn't see the fall off in deposits, and we wouldn't see these interest rate spreads widening if there wasn't this crunchy type environment that I'm talking about. I think I've rambled enough for you here in this weekly reviews. I do hope that it helps you understand a little bit more about the information that has to get paid on a monthly basis by the government. I hope you kind of see the fact that it does look like inflation is coming down and getting under control. And I hope looking at the professional forecaster survey from the Philadelphia Fed gives you a good view of what many people are thinking. They think it's just going to be a slowdown in growth, a rise in unemployment, a decline in inflation, and interest rates holding. As an investor, that should be very, very helpful for your framework as you move through the rest of this year. So with that, thank you for joining me today. We'll be back again next week to give you an update on all the data that's coming out next week. Just to give you a sneak peek, you've got retail sales information, you've got industrial production, as well as some Fed survey data on manufacturing from Philadelphia and New York that we need to cover as well. So stick with us. Thank you. Don't feel free to like and subscribe to these videos. We're going to continue to post them once a week. Leave me a comment, shoot me an email if you have any questions at all. I'll be happy to answer them or research a topic to dive a little bit deeper here. Have a great week. And again, we'll be back next week for another update.